We put together a couple of video series on direct indexing because we get a lot of questions around the pros and cons, pluses and minuses of using direct index versus other vehicles. And so today I'm going to talk for a couple minutes on an episode titled Direct Indexing 101. And later in the week, we're going to release 201. But to put it in context, a direct index is a structure. Other structures would be mutual funds, unit trusts, SMAs, and ETFs, not to mention others. So the first thing I would say is let's look at it in the form of a structure, which is what it is. The second thing I wanted to do is just kind of go back in history a little bit and talk about the creation of the first ETF. So the first ETF was created over 30 years ago. And the reason it was created was because investors wanted to invest in the S&P 500, but they didn't want to buy 500 different stocks. They didn't want to have to put in 500 different purchase tickets and pay a commission every time they did that. So what was born out of that was a new structure called an ETF, and they were able to take those 500 stocks, put them into one structure, and you could put in one transaction to buy or sell it. And it's evolved a lot since then. So today in the United States, we've gone from one ETF to over 3,000 ETFs. The second thing I wanted to look at historically was the first use of an index that was widely used by financial advisors called the dogs of the Dow. And the way the dogs of the Dow worked is you took the 30 stocks within the Dow Jones Industrial Average, and once a year on January 1st, you would rank them from 1 to 30, and you would buy the 10 highest yielding stocks. And the argument went that they were the highest yielding because they were the underperformers. And so if you could buy them while they were underperforming, you'd have a better chance to improve the following year. And you would do that every year. You would just reconstitute the Dow Jones Industrial Average by the highest yielding stocks. Well, what happened is over the last 30 years, the ETF industry exploded. The SMA business ran up very hard through the 2000s, 2010s as sort of plateaued to some degree, similar to mutual funds, but sort of on the fringes, we're starting to hear these grumblings and developments of the direct index business. We've seen most of the major firms from Morningstar, Goldman Sachs, S&P, BlackRock, Vanguard, Schwab have all launched some version of a direct indexing platform. So we wanted to just stop for a minute and just sort of say, what is it that the industry currently provides from a direct index standpoint? So as we've already talked about with the dogs of the Dow, it starts with an actual index. So the industry today largely focuses around big, well-known indexes like the S&P 500 or the Dow Jones Industrial Average or the S&P 100 as an examples. Then what happens is the industry is basically said the benefit of breaking apart an index and being able to have access to the underlying stocks gives the investors some real advantages. The first one is the ability to tax loss harvest it. So all of the firms that are in the direct index business underscore the importance of the investor's ability to sell the losers and harvest those losers so that they can be used to offset gains in the future. The second big common benefit that most platforms underscore is ESG investing. So as environmental, social, and governance becomes more and more popular in the United States, more investors are saying, is there a way I can break apart an index like the S&P 500 and eliminate stocks that don't score well on E, S, or G? Or for that matter, can I just buy the ones that score the best on E, S, and G? We see this much more prevalently used in Europe. The third common benefit that everybody agrees to is the customization. So an investor can go into an index and customize it. And by customization, what we mean is the ability to delete or overweight certain things. So a certain thing could be an industry, it could be a sector, it could be a country, it could be anything that an investor wants to overweight or underweight. An example of that would be an investor that says, I want to own the S&P 500, but I'm really bullish on technology. And so they could add more to technology and delete other industries like utilities as an example. And that becomes customized. So those are really the three biggies: customization, ESG, and the ability to tax loss harvest. The other key benefits are, one, there's a different cost structure in place. So with the direct index, by definition, you're no longer in a separately managed account or an SMA. You're no longer in an ETF, or you're no longer in a mutual fund. And so those have varying degrees of costs and fees associated with them. In most cases, we see direct indexing being less expensive than a lot of the traditional product types. The big questions that we have are, one is, how many investors are looking to do tax loss harvesting? Is this just sort of a tool for the wealthiest of clients? Or is this something that all clients would benefit from? The second thing is, on the ESG front, how many investors really want to customize a portfolio with ESG scoring criteria attached to it? And thirdly is the customization. How many advisors and their clients really want to customize based on a preference over certain industries or certain investment strategies? And having looked at this very hard with our team over the last couple of years, we've concluded that that those aren't necessarily the big drivers for a financial advisor and their client, with the exception of tax loss harvesting. But most financial advisors and their clients today are not doing a lot of ESG screening or customization. By and large, the reason for that is you're not really sure if it's going to add or hurt performance when you factor in those things. So that's a summary of the basic benefits and a little bit of the history of direct indexing. Later this week, we're going to dig into what are different ways that you can direct index that actually add more value to a financial advisor and to their client. Thanks for watching, and we'll share more with you later in the week.